Hey there, investors, and welcome to our channel. Today, we're going to dive into a company that you've probably never bought a product from directly, but it's at the heart of almost all the tech you use every single day. From your smartphone to your car, and especially at the core of the artificial intelligence revolution. We're talking about Taiwan Semiconductor Manufacturing Company, or simply TSMC, traded on the New York Stock Exchange under the ticker TSM. It's the biggest contract chip manufacturer in the world, a true silent giant. With the demand for AI blowing up, many are asking, is TSMC the safest bet to ride this wave? In this video, we're going to break down TSMC. We'll look at their strategy, their amazing economic moat, their financial strength, the main things that drive their profit, the risks you need to know about, and how the company uses its money. Stick around until the end to get a full picture and decide if TSMC deserves a spot in your portfolio. Let's get started. Strategy and business outlook. To understand TSMC, we first need to understand what a foundry is. Imagine that Apple, NVIDIA, or AMD are brilliant architects who design the most advanced skyscrapers in the world. They have the blueprint, the design, but they don't have the construction company to build the building. TSMC is that construction company. TSMC doesn't design its own chips, it manufactures its customers' designs. This pure-play business model was a brilliant gamble. With a market share of about 60%, it is the absolute leader. But this market is brutally cyclical. In times of high demand, foundries invest heavily to increase capacity. When demand drops, these super expensive factories can be underused, which crushes profitability. So what's TSMC's strategy to dominate such a volatile market? Simple. Always be at the cutting edge of technology. They focus on the most advanced process nodes, which are used in the most powerful and expensive chips, like iPhone processors and NVIDIA's AI GPUs. After this technology matures a bit, they apply it to cheaper products, maximizing the return on each innovation. And the outlook? Two long-term growth factors stand out. Integrated systems. Industry consolidation and increasing complexity require more and more integrated chips, made with the most advanced technology that only TSMC can offer at scale. Megatrends. The growth of artificial intelligence, the Internet of Things, and high-performance computing is insatiable and should last for decades. Think about self-driving cars, data centers, smart cities. All of this needs the processing power that TSMC manufactures. To balance things out, let's see what the optimists and pessimists say. The bulls say, their economies of scale and cutting-edge technology ensure superior gross margins. Tech giants like Apple, NVIDIA, and even Amazon, who design their own chips, depend on them. The bears say, technology matures and becomes a commodity quickly, putting pressure on prices. Competition from Samsung and especially Intel, which now has strong support from the American government with the CHIPS Act, is a real threat. Also, geographical diversification to the United States and Europe increases costs. The strategy is clear: technological leadership. But what really protects it from competition? That leads us to its economic moat. Economic moat. The famous investor Warren Buffett made the term economic moat popular. It describes how a company can stay competitive for a long time. TSMC's moat is one of the widest and deepest you'll find in business. It's built on two main things: special assets you can't touch, and a cost advantage. The special asset is their lead in technology. With each new generation of chips, the tiny parts called transistors get smaller, faster, and use less power. The key measure here is PPA. Power, performance, and area. TSMC consistently delivers the best PPA in the market. For those who aren't experts, making chips has faced huge technological hurdles. FinFET. This was the first big challenge around 2015 for 1614 nanometer chips. Think of it like going from one-story buildings to skyscrapers to fit more transistors. Many competitors, like Global Foundries and UMC, stopped there. GAA, Gate-All-Around. This is the next big step for 3 and 2 nanometer chips. It's even more complex and expensive technology. TSMC plans to use it a lot starting in 2025. Only TSMC, Samsung, and Intel are seriously in this race. This leadership creates a positive cycle. The best technology attracts the best customers, like Apple and NVIDIA. These customers guarantee demand and pay extra, which makes it worth spending billions on research and development and investing in new tech. This huge investment keeps TSMC ahead of everyone else. Smaller competitors can't afford to invest as much and fall behind. Besides technology, TSMC has other special assets you can't touch. Their strong relationships with customers are super important. Apple and NVIDIA share their future product plans years in advance, which helps TSMC plan how much they need to produce. This lead in technology and relationships is the main reason why TSMC makes almost twice as much profit as its closest competitors. Profit drivers. Okay, the moat is impressive, but how does that turn into numbers and growth for investors? Forecasts show revenue growing almost 16% per year for the next 5 years. That's amazing for a company this big. Where does this growth come from? Product mix. A bigger and bigger part of the money will come from the most advanced and expensive chips, from 7 nanometers down to the future 2 and 1.4 nanometers. Special applications. Chips for the Internet of Things and cars, which need older tech but in huge amounts. The main driver, without a doubt, is high-performance computing, which includes artificial intelligence chips. The demand for NVIDIA's GPUs and the custom chips from Google, Amazon, and Microsoft for their data centers. All of it goes through TSMC. This part of the business is already the biggest for the company and is growing the fastest. And what about the profit margins? The company aims for a long-term gross margin above 53%. For 2025, they expect a gross margin of 57% and an operating margin of 46%. This is because the 3-nanometer chips are becoming more profitable, and the AI revenue is exploding, which also has high margins. Financial strength. A tech company that invests billions needs a strong balance sheet, and TSMC's is a true fortress. Net cash position. For over 10 years, TSMC has had more cash than debt. This is incredibly rare and gives them huge financial flexibility. Stable margins. Even in a cyclical industry, their annual gross margin has stayed in a healthy range between 46% and 60% over the last decade. This shows their pricing power. Reliable dividends. And here's a key point for many investors. TSMC has never stopped paying dividends since 2004 and is committed to not cutting them. They've been consistently increasing their dividend per share. This combination of a solid balance sheet, high margins, and a growing reliable dividend shows extremely disciplined and successful financial management, even with the colossal investments the company needs to make. Risk and uncertainty. No investment is completely safe, and for TSMC, the risks are big and need to be taken seriously. Let's break them down into 4 main types. 1. Geopolitical risk. This is the big, obvious problem. Most of TSMC's chip making, especially the most advanced kind, happens in Taiwan. The disagreements between China and Taiwan are the biggest risk for the company, and honestly, for the whole world's tech supply chain. If things got worse, it would cause huge, unpredictable problems. 2. Customer concentration. TSMC relies heavily on just a few customers. In 2024, their biggest customer, likely Apple, brought in 22% of their money. Their top 4 customers brought in about 50%. If Apple, for some reason, decided to switch to Samsung or a future Intel foundry, it would be a massive hit. NVIDIA becoming a big customer helps spread out the risk a bit, but the problem is still there. 3. Competition and cost pressure. Samsung is a tough competitor, and Intel, with billions of dollars from the US and European governments, is determined to become a tech leader again. TSMC's new plan to build factories in Arizona, USA, Japan, and Germany helps reduce geopolitical risk, but it also makes building and running these factories much more expensive, which could cut into their profits. 4. Operational risks. Making chips uses an incredible amount of land, power, and super clean water. The company constantly faces challenges in getting these resources, especially in Taiwan, which deals with droughts and earthquakes. These risks, especially the geopolitical one, are the main reason why TSMC's stock, even though they're so dominant, might trade at a lower price compared to other big tech companies. Investors need to be okay with this level of uncertainty. Capital allocation. How does TSMC's management use the company's money? Historically, in an exemplary way. Their ROE, return on equity, and ROIC, return on invested capital, are much better than their competitors. They are careful with their investments, usually putting 30% to 50% of their income into capital expenses, CAPEX. This means they invest based on what they expect people will need in the future, which helps them have more steady profits. And how do they give money back to their shareholders? The most important thing is dividends. Their policy is clear. They want to keep dividends the same or increase them every year. Buying back their own shares is a secondary thing. However, there's a recent thing to watch out for. Morningstar lowered their capital allocation rating from exemplary to standard. Why? Because of the decision to invest $100 billion in the Arizona factory. TSMC itself admits that building and running things in the United States is much more expensive. Many people see this decision as more about politics than just business, which could affect future earnings. Conclusion and verdict. So, what's the final word on TSMC? We've got a super interesting investment case here. On the good side, we have a company that pretty much rules its market, protected by a super strong mix of tech and relationships that seems impossible to beat. It's right in the middle of the biggest tech trend of our time, artificial intelligence, and it has amazing financial strength and a history of being really smart with its money. On the flip side, the company operates under a cloud of geopolitical risk that you just can't ignore. Having too many eggs in one basket with clients is a weak spot, and competitors, even if they're far behind, are getting a boost from government help. Growing globally, while necessary, brings its own set of challenges with costs and getting things done. Investing in TSMC is like betting on continued tech leadership and a stable political situation in that region. It's a belief that their role is so vital to the global economy that political powers will find a way to keep them up and running. The final decision, as always, depends on how much risk you're okay with. If you think the good stuff from AI outweighs the political worries, TSMC could be a key part of your long-term growth investment plan. If the political uncertainty in Taiwan keeps you up at night, maybe it's better to look for opportunities elsewhere. So, what do you think about TSMC? Is it a clear buy or a risky trap? Let us know what you think in the comments below. We'd love to chat with you all. If you enjoyed this analysis, don't forget to give us a like, subscribe to the channel, and turn on notifications so you don't miss our next videos. Thanks for watching, and see you next time.